Hello everyone, welcome back to my channel FRM Unplugged. Today we will be starting the question bank on the first paper of FRM part 1. So the first paper is essentially quite theoretical, but these theoretical concepts are primarily based on what we will study in book 3 and book 4. So if we kind of have some feeling in our mind that the book 1 needs to be read first and then book 2, it's not like that. So book 1 has many concepts where the details are there in book 3 and book 4. So it is imperative we have a solid understanding of the derivatives, fixed income, time value of money, a bit of statistics, which is quants, then come to this paper, which is the paper 1. So today we will be starting the chapter 4 of the first book, which is credit transfer mechanism. Right? So this basically deals with credit derivatives. So I hope that people who are watching this have some elementary idea of derivatives in general and credit derivatives in particular. Basically, it is to separate credit derivatives are instruments which separate the credit risk from the underlying exposure. So let us start with the question bank. So I have just selected the few questions from our Swayzer book and a few questions from the GARP book. I think if we are having solid understanding of these questions and the concepts, I think we need not get into some additional questions for this chapter, because these questions which are there for in the GARP book is and Swayzer is sufficient for building our concept and testing our concept basically. So starting with the first question, from the perspective of a bank, which of the following is not an advantage of using a collateralized debt obligation to transfer credit risk? Like I have mentioned maybe more than 10 times that please read the question carefully. Here it is required that we have to say which is not an advantage, which means all the three are advantage and one is not an advantage of using a CDOs. I believe we all know CDO is a type of credit derivative. So CDS is one credit derivative, CDO is one, CLO is another. So like that. So CDO is a credit derivative. Now, a bank profitability can be accelerated due to higher loan turnover. Yes, this is a benefit. Credit risk is effectively transferred to investors. Correct? Because we know that the bank will repackage these loans as investable securities, where a normal investor who is not having any underlying exposure on loans can still have a pie of this. So point B is also an advantage. What about C? There will always be a market for CDO products. So we are kind of not very sure on this. So let us look at point D. A large pool of potential borrowers will exist due to less concern for lending standards. Okay. So obviously D is also an advantage, because we know that the originate to distribute model, I would not say they have thrown the credit caution to the winds, but yes, they have kind of had a lax credit appraisal process. So people whom in US language they were called as subprime. So those kind of borrowers who do not have well-defined income or very stable income or has good net worth, so those kind of people, or who doesn't have a good credit history or no credit history at all, even those guys also will have a chance at getting a loan. So effectively we are left with the point C. So this C is not an advantage. Now if you look at it, even why is it not an advantage? Because we can't say for sure that there will always be a market for CDO products. What happens if the bank loans which the bank has given, they start defaulting in large numbers? then these CDO products will lose their shine, no? Because we know this CDO has tranches, right? Equity tranche, medium tranche, and the senior tranche, right? So in case the loans start defaulting much more than what is anticipated, then only the equity tranche will not get hit. Even the junior and the senior tranches will also get hit. So this point C is not correct. There may or may not be. So there will always be is not the correct advantage, right? Now the second question is, which of the following is not a traditional credit risk transfer approach? Marking to market, yes, marking to market is a proper credit. So marking to market, I believe all of us understand it. Just to reiterate, if I enter into a transaction with another party, and wherein I undertake to buy a certain commodity from that guy after 90 days, and on the 30th day the price of the commodity increases, then I need to be giving some additional margin to that party because of mark to market. So every day, depending on the market price of the commodity on which I have undertaken, so that is tracked in a day-to-day basis. So that way you are mitigating the risk. Similarly, banks will also use this with their counterparties. So MTM is a valid credit risk transfer approach. Call feature will just hang on for a while. Exposure netting. Obviously, if I have maybe 5 contracts with counterparty B, and in 3 I get something, and in 2 I have to give something, then we will net off the position to know only the delta, whether I have to give or I have to receive. That is the netting. And loan syndication, obviously. So if, let's say, a customer, like, let's say, maybe a new customer, new large corporate, maybe Adani Group has approached a State Bank for funding their, let's say, Australia coal mine. So State Bank will only lend up to, if $100 is the total cost of the loan, SBI will only lend till $50, and the rest 50 it will say that, okay, you take it from other banks. So this is syndication. So that way also SBI has kind of managed its credit risk. So what is left? Left is call feature. Now, call feature, call is calling back. So sometimes, bonds, the issuers, if I have issued a bond, and if I feel that due to certain adverse interest rate movement, the price of the bond at which it is trading is not as per my expectation, then I have the option to call back the bond. So this is basically not for credit risk. This is to mitigate the interest rate risk, because due to interest, so bonds, the interest, depending on the interest rate fluctuations, the prices will vary. So this is more to deal with interest rate risk, which is market risk, rather than credit risk. So point B is the correct answer. Now, the question 3, which of the following was not a direct cause? So let us go by the use of credit derivatives, dicey. So let's look at the other ones. Weak regulation, it was a direct cause, right? Because just remember that at that point, banks were, the regulation was not very strict on the banks to have a well-defined and watertight, carved in stone kind of a credit policy. It was supposed to be kind of flexible, and banks used to even make it more flexible to allow the subprime borrowers also in their net. Excessive speculation, yes, excessive speculation was a reason, because if you remember that CDS is so it's like an insurance, but it's more than like an insurance, because I can take a view on that CDS even without me having an underlying exposure on the reference asset. So if there is a CDS on a bond issued by ABC, I can take a view on that CDS even without me having any short or long position in that bond. So excessive. So when I am not having any interest in the underlying position, and still I am having a view, what am I doing? I am speculating. So that was one of the reasons. So speculation was also a reason. Adjustable rate loan resets, yes, we all know that, when the loans was originated, the rate was very less. After 1 year or after 2 years, the interest was supposed to be set at the prevailing market rates. So adjustable rate loan resets was so the only thing left is point A. So it was not a direct cause. See, understand the English used here. The use of credit derivatives was not a direct cause. The misuse of the credit derivatives was a direct cause. So the normal use was not. So point A. Credit derivatives were in vogue prior to the financial crisis also. And we all know that even CLOs, so I'm not talking about CDO, but CLO, which was which was also a credit derivative, it never faded even after the great financial crisis. So the credit derivatives in itself were no villain. The way they were kind of excessively leveraged themselves by having massive speculation, no, that led to the undoing of the entire financial system. So that is how we have to kind of assess this kind of questions. Now the next question, which of the following is not a strength of the securitization process? Let us look at the options. Okay. See, it is advisable not to quickly jump into the answer. Just see what is the question. Which of the following is not a strength? Which means we have to figure out the rest three which are actually strength. Now, enhances credit product access for low quality borrowers. Yes, because like I mentioned, since the banks were not having very hard or very strict lending process, even low quality borrowers also could get loans. Risk can be distributed to multiple market participants. Yes, because bank used to package the loans, sell, put it in an SPV as a CDO CLO. That CDO CLO was kind of open to investors from all types of market players. They could be market makers, they could be simple corporate or institutional investors. So point B is also taken. Enables a transparent four-step process, dicey. So let's look at the fourth one. Enables borrowers to lower their borrowing cost. Yes, this is also because in this case, even the whether it's the normal borrower or even the subprime, their cost will be, because banks will be giving them so many benefits of because the bank will eventually hive it off to a SPV. So bank will not be that much critically assessing the profitability as such, because anyways they will kind of move it to a SPV in some time. So then what is left is point C. It does not have a transparent process. Somehow, if you see how the tranches are created, okay, actually financial engineers are supposed to do this job of creating tranches, the equity tranche, the medium tranche, and the senior tranche. And they are so created so that the senior tranche gets maybe AAA plus or AA plus or AAA minus kind of a rating. So no one knows what goes into this. So there is a method. It's not that it's total madness, but it's quite opaque. So point C is the correct answer. It is not a strength. Not having a transparent thing is not a strength. So, okay. Now, fifth question, the securitization mechanism underlying the subprime CDO played a central role in bringing about the 2007-9 global financial crisis. True or false? So we just discussed the securitization mechanism in itself was not the culprit. So this is the false. Now the next question. In a securitization, the bond classes are issued by the loan originator and guaranteed by the special purpose vehicle. So both of them are false actually. Here you could have got a question like this and answered that, okay, first part is correct, second part is false, first part is false, second part is like that. But just this is a simple question, so to speak. The bond classes are never issued by the loan originator. Bond classes are always issued by the SPVs. Bank has the loan in its assets, bank will put it in an SPV. SPV needs money to buy this loan from the bank, no? So to fund the SPV's assets, the SPV will issue the bonds. So that is false. And nor is it guaranteed by the SPV. SPV never guarantees the repayments. Sorry. Credit default swaps allow the transfer of credit risk without impacting funding or relationship management. So credit allows the transfer of credit risk, yes, without impacting funding or relationship management. Correct. So because anyways the normal the person who has taken the loan, he is not concerned with whether it has been hived up into an SPV or it goes on paying by itself. I mean, if I am the borrower, I will kind of, life is as usual, same for me. It doesn't change. I will make the whatever is the loan scheduled in 10 years, 15, 20 years. I'll just keep doing the payment. It's not my lookout whether the payment is going via a waterfall method. First the senior tranche is getting, then whatever is left is getting the junior, and then the final one is being taken by the equity tranche. So I am not bothered with all that. So now the next question. The originate to distribute business model reduces the incentive for loan originators to monitor the credit worthiness of the borrowers. It reduces the incentive, yes, because tomorrow I will kind of means this question is 70% correct. So we can't say that it reduces the incentive, but there is still an incentive for the banks to assess the credit worthiness, because some part of the repayment is guaranteed by the bank itself, because there are some security wraps also given to for the tranche which is rated AAA minus. So on the whole, it reduces the incentive, but it never kind of eliminates. So there is some amount of incentive for the bank to have a proper assessment, but yes, it is lax. In a typical securitization, sources of funds are mainly several classes of debt with different ratings and a relatively large equity tranche. So always remember that whenever these loans are getting, this credit risk, there is an entire module, entire book in FRM Part 2, which details out how these tranches are made, how the loans within the tranches are correlated, how increasing the correlation makes the default, and all those things. So for now, just know that whenever the loan is repackaged into CDOs, majority is the senior, then comes the medium, and then the last is equity. Equity is typically a small portion. Equity is like the small portion. So the major hit, if the customers stop paying or the defaults happening, this comes to here equity. So whenever we are getting the payment in this tranche, first the senior is getting, then the mezzanine, and then equity. So equity, so here is a relatively large equity tranche. No, equity tranche is not more than usually 10 to 15% of the entire tranche. Which of the following cannot be used to transfer credit risk from a bank's balance sheet? Credit derivatives, credit default swaps, securitization, US government bond features. Obviously, this is the correct answer. All of the first three can be used to transfer credit risk from a bank's balance sheet. Credit default swaps. Now the next question. Credit default swaps helped transfer credit risk in the loan book, but also generated new dash of a systemic nature. So credit helped transfer, but also generated a new counterparty credit risk, because whenever I am doing a, let's say if I am the bank, okay, I have invested in, so bank has the capital requirements to, now there are various types of capital that the bank can raise. So not the core capital, but the next level of capital when the bank wants to raise, bank can invest in a bond, let's say, of a good rated company for 30 years, let's say. Now, if now the bank, till now, there was only a risk of the bond issuer not paying the interest income during the life cycle, and at the end the face value of the bond. So this risk was there in the bank's balance sheet. What the bank did, bank thought of hedging this risk by entering into a credit default swap. So bank probably contacted a counterparty B, okay, and said that, okay, I will pay you this much premium, I want to buy credit security. So I am long on it, I want to buy it. So then it will start making the premium payment. We know the normal credit default swap process. Before CDS, bank was having risk of default from the bond issuer. After CDS, bank is also having to deal with this party B from which it purchased the CDS. So the terms and conditions of the CDS is, if there is any credit event, and for the purpose of our discussion, let's make it a point not to, because that's the very obvious one, default. Let us forget default as a credit event. Let us take a credit event as 3-notch credit rating downgrade. That is also a credit event. So if there is a 3-notch credit rating downgrade of the bond issuer, then this guy B, from which the bank has purchased CDS, bank had paid premium, now at the credit event the party B has to give some amount to the bank. What about if that party B is not able to pay? So this CDS has also introduced a counterparty credit risk, no? This is why we are saying B is the correct choice. Okay. Now, credit risk includes, like we were just now discussing the credit event. All the credit events combine together to form credit risk. We can visualize it that way. So what does a credit risk include? Credit risk includes the risk of default, yes. The risk of upgrades, downgrades, yes. Credit spread risk, yes. All of the above. So obviously all of the above is the correct answer. Now, the last question, if you see, okay, what are the contractual specifications for the protection seller of a credit default swap. So the one where this, in our previous example, party B from whom the bank B purchased it. So bank purchased it and party B sold it, right? Seller. So the protection buyer pays a premium to the buyer until a credit, in which case the protection seller pays the protection buyer compensation for the credit event. This is correct. If a credit event occurs, the protect seller is obliged to exchange contractually specified assets for government bonds. This is incorrect. Nowhere is this a part of the contractual specifications. Okay. Let's see what's the third one. See, in these kind of questions, no, since we will always be running against time, this point A is appeared to be correct, right? So here it is not about, so we have to just mention the correct one. So we need not read also B, C, D. Had this been those kind of question, which of the following is not, then we are kind of bound to read the other options. But here we are saying what are the conditions. So first one is appears to be, I mean, not appears, we are reasonably sure it is correct, right? No point wasting our time reading B, C, and D. But for the sake of our discussion and understanding and development of our concept, let us read what is there. Point B, if a credit event occurs, yeah, it is not specified in the contract. The protection seller pays a premium. Never. The buyer will pay a premium, right? If the underlying of the credit default swap is a bond issued, only this corporation can act as a protection seller. Again, this is not correct. So point A is the correct answer. Just with this, I think you can expect one question from this chapter. Just keep those concepts clear. CDS, CDO, CLO, and the securitization. CLOs, always remember that CDOs were credit derivatives where bank did not have good underwriting processes, but for CLOs they had undergone thorough rigorous assessment. So CLOs there were takers for CLOs even after the global financial crisis, but not the same for CDOs, which were essentially mortgages basically. So if most of the debt in a CDO is mortgage, we also call it as CMOs. Otherwise, CDO is a mix of credit cards, vehicle loans, and mainly mortgages. This we have to keep in mind. The modus operandi of CDS, which is paying the premium and then on the credit event paying compensation back to the credit buyer. We will have to understand why speculation led to the global financial crisis, like I think we discussed in one of our questions, that for this, when okay, now we can revisit that. So let us say we discussed one scenario where bank B had bought bonds from company, and to hedge its risk, it approached counterparty B that okay, I will pay you this much premium, you will have to pay me back compensation on the basis of a credit event. In this particular scenario, this is not a speculation because bank had a position on the true underlying, which is the bond. Bank had invested in it, which is the bank was long in it. But let's say this bond issuer was XYZ and bank had bought the CDS from counterparty B. Now, if I am a market maker, let's say, or I am an institutional FII, foreign institutional, like Lehman Brothers, like in insurance, I can only buy insurance for a product that I hold, a car that I have. I can't buy insurance for a car which I do not own, right? But in this particular case, though we will find similarities with the insurance, but for CDS, always remember to have a position view on that CDS, you are not required to have a stake in it. So in this particular case, let's say this bank would have invested $100. So it would have purchased maybe $100 worth of, or say $70 to $80 worth of protection from B. Now, what prevents another person also from a market maker like Lehman Brothers? It will also kind of try to have a view on this bond that was issued by XYZ, and it will also kind of try to speculate, and it will maybe start buying CDS or start selling CDS depending on its view. So it will try to go long or short. So for $100 worth of bonds, no, into $100 worth of positions can be created, which you will find that in 2015 or 18, around 90% of the entire credit, so the total credit derivative market was around 4 to 5 trillion dollars. Sorry, and 4 to 5 trillion dollars is not a small amount. Obviously, 4 to 5 trillion dollar is not the value of the instruments that has been issued, right? This $4 to $5 is the total position on those instruments. So the instruments could have been maybe $1 trillion, but the total exposure is 5 times. So due to this speculative nature, and eventually when the customers started defaulting, and banks were then, whoever had bought the CDS were kind of making the claims, and whoever was selling, whoever had sold the CDS, they were not in a position to honor due to the massive liquidity strain prevailing at that time. So this we have to keep in mind, and the tranching we have to always keep. See, again, the waterfall model and all will come in part 2, but just remember, whenever the bank hives it off as a senior, mezzanine, and then equity. Equity is like the owners, they take the maximum hit, and any payment that comes, the priority is senior tranche holders, then mezzanine, then equity. So if I have invested in the senior tranche, my return would be maybe 2% or 3%. But if I have invested in the mezzanine, my return would be 4%, and the equity one may be 7 to 8%, because the equity tranche is the most risky tranche. So I think with that, we can safely conclude that we have covered most aspects of it. This is a very, very important chapter. I would expect at least one question. I mean, there is no point we will get 2 questions from here, but one question we can expect from this chapter, because this is very important, and it's going to come up in part 2. And if you want to take this FRM if you are a risk professional, then this will continue to aid you even in your work. So I would suggest to have a good grasp and thorough understanding of this. Any queries, if you have, do put your comments in my channel, and I will try to get back to you. Thanks for your time and patience. We will shortly get back with another chapter of paper 1 of FRM part 1. Thank you.